about the financial results, and the third section would talk about the segmental performance. Starting with the group performance highlights, I think the year 15-16 has been one of the most challenging years for the infrastructure sector and the capital goods industry. There is no doubt about the potential of the country or its economy to get on to growth path. The most important aspect that all of us in the industry and in the government are dealing with are the levers that needs to be moved to make sure that the potential of the country is transformed into viable and sustainable opportunities. While the government and the industry is striving to make these opportunities into viable projects and programs, the company has been focusing on converting the substantial order book that it has into profitable revenues. Possibly this approach is evident from the fact that the company has done better than the previous year in most of the parameters that feature the company's operations. While the decline in the order inflow is reflective of the investment sentiment that prevails in the country and in the industry at the moment, the fact that the company has been grow its revenue by 12% in FY16 over FY15, the fact that it has been able to grow its EBITDA by 10%, the fact that it has been able to increase its profit after tax by 7% is adequate testimony of the fact that the strategy to focus on what is available and within company's control needs to be maximized. Looking at the financial results of the company won orders worth 1,36,000 crores, and that is a 12% reduction over the 1,55,000 crore that we won in the previous year. Through the course of this year, when we set ourselves up, we are looking at a growth of close to 15% over the previous year. But as the years rolled on and the months rolled by, it became apparent that the opportunities that we were targeting were likely to be deferred. Some of them cancelled, but most of them deferred. Consequently, we had to get selective in where we bid for, because it is very important to bid for projects that are viable and that can be executed within cost and time. Consequently, notwithstanding the 43,000 crores worth of orders that we picked up as a company in the quarter 4 of the year, we ended up the year with 1,36,000 crores. The mix of the orders is 32% international and 68% domestic. And the fact that the domestic markets did not yield to the way that we anticipated in the year ahead is evident by the fact that the share of international orders are a little larger than what it was in the prior year. The order book is at 2,50,000 crore, which is up 7% over the 2,32,000 crore of the previous year. And 28% of this order book is for contracts that needs to be executed in the international markets. The good thing about this order book is it provides the next 3 years revenue visibility for the company without having to battle the task of winning orders to report revenues. Where did these orders come from? There are no prizes for guessing. Much of the investments during 15-16 has happened in the infrastructure sector. So 62% of the orders that we won during the year 15-16 came from infrastructure sector. And this was higher than the 55% share that we reported in the prior year. Hydrocarbon had 7% share, but services, which is included here to complete the story of the portfolio, is about 16%. But pretty much the rest of the sectors have been reflective of the lukewarm investments that have been featuring those sectors. The order book of 2,50,000 has almost 1,87,000 in the infrastructure segment, which means a 75% share of the total order book is in the infrastructure segment. The health of the company, its revenues and profitability going forward depends on how smartly we execute the 1,87,000 crore worth of orders that has been backed by the company. We have 19,000 crores of orders representing the next 2.5 years of execution in power business. We have 15,000 crores of orders in hydrocarbon segment. Metals and minerals, which have been seeing a lot of headwinds, is at 10,000 crore. and heavy engineering business, which also has been suffering the headwinds on account of decline in oil prices and global overcapacity, is at 7,500 crore. The rest of the business constitute 6,800 crores. Getting on to the numbers specifically, the net revenues that the company earned from its operations for the quarter 4 is at 331 billion rupees. I'm switching over to billions of rupees, which is a 18% growth over the quarter 4 of the previous year. And for the year as a whole, it is at 1,02,000 crore, which is 12% growth over the revenues of the previous year. It's important to note that 30% of these revenues for quarter 4 and 32% of these revenues for the full year came from international contracts that are under execution. The increase in the manufacturing and operating costs of the company is reflective of the level of activity and hence is in line with the planned increases. The increase in the staff cost, however, 9% for the quarter as well as 14% for the full year, is reflective of the staff augmentation that we were doing to execute the projects, particularly overseas. The sales administration cost at 16 billion rupees for quarter 4 and 61 billion rupees for the full year is reflective of the general selling and administrative expenses of the company and the provisioning that the company was required to make for receivables doubtful of recovery. Since these are consolidated financials, these represent all the businesses the company is engaged in. So these provisions representing doubtful debts are across the portfolio, which includes financial services. The company has reported a 10% growth in the EBITDA at 123 billion rupees for the full year, and for the quarter 4 it is at 48 billion rupees, representing a 35% growth. The EBITDA margins, however, in relation to the revenue growth is at 12% for the full year, which is a 20 basis points reduction over the 12.2 of the previous year. Being a project company, it doesn't make much meaning out of the quarterly variations in the EBITDA, and this we have been communicating to the markets quite regularly, that the quarterly EBITDAs are misleading for drawing annual conclusions, and annual numbers are better reflective of the trajectory of the profitability of the company's operations. The interest expenses for the year at 30 billion rupees is up 7% for the year, whereas at 7 billion rupees, it is up 65% for quarter 4. It is important to note that the variation in interest expenses for quarter 4 is largely on account of commissioning of realty and other developmental projects, which were into execution mode in the previous year and hence facilitated interest capitalization. On being commissioned in the current year, the interests are to be taken to the profit and loss charts, and hence you find a sharper increase in the quarter 4 interest. The depreciation at 27 billion rupees is up 5%, and apart from the normal increase in the provisions for depreciation, there is also a certain impairment charge that we are carrying in those numbers, representing a toll road that we have surrendered to the government on termination for event of default by the counterparty. After providing for taxes and the minority interest share of profits, the profit after tax for the company for the year is at 50.91 billion rupees, which is up 7% over the 47.65 billion rupees of the previous year. And for the quarter at 24.54 billion rupees, it's up 19% over quarter 4 of the previous year. The company has 10 segments, and these segments are infrastructure, power, metallurgical and material handling, heavy engineering, electrical and automation, hydrocarbon, developmental projects, IT and technology services, financial services, and the rest. Looking at each of these segments in some detail, infrastructure segment, we have a revenue of 486 billion rupees, which is 12% increase over the 432 billion rupees of the previous year. And for quarter 4, the revenues of infrastructure segment is up 20% at 180 billion rupees as compared to 150 of the previous year. The share of the international revenues of the infrastructure segment is 145 billion rupees out of the 486 billion rupees, and for the quarter 48 billion rupees out of the 180 billion rupees. The EBITDA margins for the year from the infrastructure segment is at 11.7%, which is 60 basis points higher than the 11.1% reported in the previous year. For reasons cited earlier, I am not focusing on the quarterly margin variation for this segment. Hydrocarbon segment has commenced its path of recovery. As we have been reporting through the past quarters, the legacy projects are being closed out one after the other, and we are in the final leg of these closeouts. And this fact is evidenced by the fact that the EBITDA margins of this sector, which was negative 1.7%, has turned positive to 2.2% for the year as a whole, in contrast to the minus 15% of the previous year. While achieving these EBITDA margins, the segment reported a revenue of 87 billion rupees, which is 20% higher than the revenue reported in the previous year. And as is the case with this business, which is largely international, the share of international revenue is predominantly high as 40 billion rupees out of the 87 billion rupees. Moving on to the power segment, the segment earned a revenue of 69 billion rupees, which is up 47% over the previous year. The segment had the benefit of large number of orders that it won in the prior year, and the successful execution of these orders has enabled the revenue to grow at a robust pace. And the robustness is evident both in Q4 revenue growth numbers as well as the full year numbers. We have won some gas power project orders in Bangladesh, and those projects are under execution and well on road, and hence the share of international revenue for the year as a whole is at 18 billion rupees out of the total revenue base of 69 billion rupees. The EBITDA margins at 11.6% reflect the mix of jobs and the margin recognition threshold these jobs are at the reporting date of 31st March 2016. In the prior year, the margins were higher at 16%, largely because of closeout of jobs that was done in the prior year. These were out of the order wins of the earlier years, 12, 13, 13, 14. When it comes to minerals, metals and material handling business, there is considerable headwind being faced by this sector. We know that because of the soft commodity prices and the global slowdown, the demand for minerals and metals have been low, and hence most of the end users who are our customers are on capacity freeze mode. The effort is to make sure that the existing capacities are utilized and profitably sold. Consequently, aided by the tariff corrections that is happening on the import of steel, there has been some improvement in the end clients' revenues and profitability. But since we are in project business, it will take a while for this sector to recover and convert these into investment opportunities. So it is our assessment for the next 1 to 2 years, we may not see substantial investment in the minerals and metal sector. But material handling is a slightly different situation, with the thrust on the mining, improvement on getting the stalled power projects completed, ensuring connectivity, investment in rail. All of this will lead to certain larger exploitation of the mining resources that we have. Consequently, the material handling systems business is expected to do better. The segment earned a revenue of 23 billion rupees in the current year, which is down by 25% as compared to 31 billion rupees of the previous year. The EBITDA margins, consequent to the decline in the order book, as well as under recovery of overheads because of capacity underutilization, is resulted in the year at 5.5%, sharply down from the 10.5% of the prior year. Heavy engineering business has 3 segments. It has process plants, which is hydrocarbon dependent, and we know that ever since the oil prices declined, the investment momentum in the hydrocarbon sector has come down, and there is global excess capacity. Consequently, the fortunes of the process plant business in the hydrocarbon segment has taken a downturn over the last 2 years. We also have nuclear equipments and systems that we supply to the nuclear power industry, and we know that the nuclear power industry, the momentum is yet to be discovered. So consequently, the capacity the company has to deliver for the nuclear segment remains underutilized.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.